Let me tell you something that sounds fake until the math starts staring back at you. There are 21-year-olds quietly investing $2,000 a month, every month, not once, not when they get a tax refund and feel spiritual, monthly. That is $24,000 a year getting marched into the market like it has a security detail. Meanwhile, a lot of people still think your 20s are only for ramen, bad decisions, and pretending your bank app is loading when really you just do not want to look. But a growing slice of Gen Z looked at rent, inflation, layoffs, and the general chaos buffet of modern life and said, yeah, nobody is coming to save us. Cool, guess we build our own safety net. And before anybody in the comments starts hyperventilating, no, I am not a financial advisor. I am a cute avatar with eyebrows, opinions, and a slightly unhealthy respect for compound growth. This is educational content, not personalized financial advice. I am here to tell you what is happening, why it is happening, what is smart about it, and what could blow up in your face if you do it sloppy. Because this trend is real for a reason. It is not just random discipline fairy dust. It is a weird little cocktail made of financial anxiety, instant access to investing apps, and a generation that sees wealth differently than the people before them. They are not waiting around for some company pension fairy tale. They are trying to own assets early while time is still cheap. A lot of young adults grew up watching economic chaos in 4K, recession, pandemic, prices acting possessed, job markets getting weird. So they absorbed a blunt lesson early. If your future security depends entirely on institutions behaving perfectly, you might be building your life on wet cardboard. That fear has pushed a lot of people to get serious fast. At the same time, they are digital natives. For them, opening an investment account is not some grand ceremony involving a mahogany desk and a man named Richard in a blazer. It is an app, a password, a couple taps, fractional shares, low-cost funds. Done. The gate got kicked open. Quick timeout. If your brain just heard $2,000 a month and immediately rolled onto the floor like a Victorian lady in a fainting spell, same. Breathe. We are not doing finance cosplay. We are doing mechanics. Because the real sauce here is not the number. It is the system. That is the part people miss. The headline is flashy, but the engine underneath it is what matters. In one recent survey, young investors said they plan to put even more money into the market than older groups. Why? Because they understand something a lot of people do not learn until late. Your biggest asset when you are young is not your paycheck. It is time. Time is the silent employee working night shift for free. So let's make this real with Tobin Atlas. Tobin is 21. Smart, ambitious, and allergic to the idea of being broke forever. On paper, investing $24,000 a year sounds ridiculous, especially when the median income for people his age is nowhere near throw money around like a tiny hedge fund territory. So how does he even pull this off? Usually, the answer is not one magical job. It is stacking. Maybe Tobin has a paid internship in a strong field like tech, media, marketing, or engineering. Maybe he freelances on the side. Maybe he does content editing, graphic work, tutoring, reselling, or some niche online service that would confuse his uncle at Thanksgiving. Then summer hits and he works full-time. One job feeds survival. The others feed acceleration. And no, this only works if he does not spend like a man trying to impress strangers at a gas station. Tobin lives with roommates, tracks spending, keeps lifestyle creep on a leash. He is not confusing "I can afford the monthly payment" with "this is actually a smart move." That discipline is a huge part of the story. The investing starts before the flexing. Now, let's talk about where the money goes. Tobin is young, which means he has time to recover from market swings. So his portfolio is aggressive. Old rules of thumb, like the rule of 100, would put most of his money in stocks anyway. A lot of young investors push even harder, 90% stocks, sometimes all the way to 100. Not because risk is cute, but because time gives them a longer runway. The core of the strategy is not exotic. It is actually boring, which is beautiful. Let's say roughly 80% of that 2,000, about $1,600, goes into low-cost, diversified ETFs, stuff like an S&P 500 fund or a total U.S. stock market fund. That means Tobin is not trying to outsmart the market with one lucky guess. He is buying broad exposure to businesses across the economy. Then comes automation. This is where a lot of people stop performing and start winning. Tobin sets up automatic investing every month. Same date, same amount. Market up, he buys. Market down, he buys. Weird headlines, he buys. This is dollar cost averaging. It removes drama, ego, and the deeply unserious habit of thinking you are going to flawlessly predict the perfect entry point because you watched 3 videos and lit a candle. He also prioritizes tax-advantaged accounts first when he can, especially something like a Roth IRA. That matters because tax-free growth over a long period is not a cute bonus. That is a serious weapon. The market does enough heavy lifting on its own. You do not want taxes showing up with steel-toe boots and stealing momentum if you can legally reduce that drag. Then maybe the remaining 20%, about $400 a month, goes into the spicy corner. Specific sectors, AI, clean energy, semiconductor plays, maybe a small speculative crypto position. The important word is small. This piece is fenced off. It is not the foundation. It is the optional seasoning. If that bucket gets punched in the face by volatility, Tobin's core wealth machine is still standing on both legs. Now, here is where the math starts acting disrespectful. If Tobin invests $2,000 every month and gets an average annual return around 8% over the long run, the numbers get loud. In 20 years, around age 41, he could be sitting on more than $1 million. Keep going to 60, and you are looking at something north of $5 million. That is not magic. That is compounding with a head start. But now we get to the part social media loves to skip because reality does not always have good lighting. This strategy has teeth. A portfolio packed with stocks can get body slammed in a downturn, 30% down, 40% down. And when that happens, all the "I am investing for the long run" talk gets tested for real. Because the market is easy to love when it is flattering you. The biggest mistake is panic selling. That is when fear grabs the steering wheel and drives your future into a ditch. If you sell at the bottom because the chart looks haunted, you lock in losses and often miss the rebound. A long time horizon only helps if you actually behave like a long-term investor when things get ugly. That is the emotional exam nobody brags about online. Next risk, concentration. Social media has turned investing into a highlight reel. You see the one person who hit a crazy winner, and suddenly everybody thinks they are one hot stock away from spiritual enlightenment. That is FOMO wearing a nice jacket. young investors can drift from, I have a small speculative bucket, to, I accidentally built my whole future on one trendy ticker and a prayer. And then there is the foundational risk. This one matters more than people think. If you are investing aggressively but do not have emergency savings, you are building something fragile. One job loss, one medical bill, one car repair that arrives with villain energy. Now you are forced to liquidate investments at the worst possible moment. That is how good plans get kneecapped. Same goes for high-interest debt. If a credit card is charging you 20-something% while your investments are hopefully earning much less than that on average, the debt is quietly eating your lunch, dinner, and snacks. Before you start acting like a market warrior, make sure you are not being mugged in the alley by APR. So what is the lesson if you are not making enough to invest $2,000 a month? You are not behind. Let me say that again for the people in the back comparing themselves to internet unicorns. You are not behind. The real lesson is not the amount, it is the habit. Starting early beats starting big. Consistency beats intensity that only lasts 9 business days. Start with 50, start with 100, automate it, use a low-cost, diversified fund. Build a real budget. Stack a 3 to 6 month emergency fund in a high-yield savings account. Kill high-interest debt. Then, invest with your shoulders down and your brain on. That is how you build wealth without turning your financial life into a reality show with sad lighting and dramatic music. So no, the takeaway is not that everybody needs to invest $2,000 a month or go cry in the car. The takeaway is to steal the principles. Start early, stay consistent, keep fees low, diversify, and do not let panic or ego tackle your future in the parking lot. Whether you are investing $2,000 or $20,000, the rules that build lasting wealth are the same. If this helped, hit like, subscribe, and send it to somebody who keeps saying they will start investing once life calms down. As if life is not a raccoon with fireworks. Check out the ebooks and check out our many financial calculators and other resources, links below. Basically, the toolbox is downstairs. Go use it before future you starts asking present you hard questions.